First, let's talk aftermath of the election. We have the flipping of the House. What does that mean for economic fundamentals, which have been good, for corporate earnings and for your landscape?
You know, I try not to focus too much on policy, more on or politics, I should say, more on the policy. And so as it relates to policy, I don't think policy changes. I don't think tax changes. I don't think it gets rolled back. I think that's status quo. And it's very, very positive for corporate earnings going forward. And I think that other policy measures are going to be really gridlocked from this point going forward. And so you won't see much get through the House. In fact, the thing that you should get through the House is infrastructure, because it's most bipartisan or nonpartisan issue that there is, and you're not going to get that through most probably because the Democrats won't want to give the Trump administration that win. But you land here in New York, you take a train, you take a car, you go over a bridge or a tunnel. The infrastructure is broken, and Washington, they're gridlocked. They're doing nothing about it. And so I think that will define kind of these next 2 years. And so I think Trump will be able to use his executive orders to be able to roll back further regulatory constraints and strike trade deals. But I don't think much gets done in Congress, unfortunately.
And yet, this president is quite a transactional president. It would seem to be in his best interest to do something on infrastructure, to do something on pharmaceutical prices, even if it were to mean bipartisan work with the Democrats.
I think he's very much willing to work with the Democrats to get done the agenda he wants to get done. I'm not sure the Democrats want to give him that win. I think that's the friction. It's become so toxic that I think it's unattainable at this point going forward. And so the next couple of years, I wouldn't say it's a lame duck president, but it's a president that does a lot through executive order and less through legislative change.
What does it mean for U.S. assets broadly, maybe from a foreign buying perspective, and from a U.S. dollar perspective? You had been looking for a drop of 10% in the U.S. dollar. Do you still see that?
Well, I think the U.S. dollar is fine. I think we're the strongest house in the world in terms of, you know, the stability of the system. So our economy grew at 4.2%. Last quarter, 3.5% this quarter. We're expecting 2.5% growth going forward next year. And with that, and with interest rates going up, I think there's going to be a relatively strong dollar bid around the globe. The repatriation of $1 trillion or maybe $1 trillion plus coming back in to U.S. from companies that are repatriating currency, I think that's important. So I think that the key, though, for kind of projections is going to be interest rates. And so it's both the fiscal deficits, which are somewhat out of control at this point. The U.S. Treasury is going to go from issuing somewhere around $600 billion a year for the last 4 or 5 years to issuing $1.3 trillion in treasuries in the calendar year 2019. $1.3 trillion with no Fed buying, because in years past the Fed had been buying from the balance sheet $200 to $300 billion a year. So instead of issuing $600 billion, they'd issue $600 billion. $200 to $300 would go to the Fed. So only $400 billion would clear the market. Now that number is $1.3 trillion that has to clear the market. And so it's a big number to fund this $1 trillion deficit that we have going forward.
Okay, so what does that mean for an area?
Higher rates.
Yeah, it obviously means higher rates, and you're saying it means a stronger dollar?
I think the dollar is fine at this current level. It can weaken, it can strengthen. I think it's all noise from here.
For credit, we've seen, ballooning issuance. We've seen massive deals and, massive leverage and increasing leverage still. So what does all this mean for, say the BBB space, which has ballooned by 50% in the last just couple of years alone? What is it at 3.1 trillion now, the market?
Exactly, Vonnie. So if you go back pre-crisis, December 31st of 2007, so before the crisis really unfolded, the amount of BBB corporate bond supply was $760 billion. Today's $3.1 trillion. That's a 400% increase. That's just staggering. The more interesting part of this is the fact that the Fed fueled it. That ZIRP, zero interest rate policy, allowed companies to borrow in a vengeful way at very cheap rates, and so they did it. And so now the magnifying glass is going to start to shift to the rating agencies, S&P and Moody's. And they're watching this very closely because they've rated nearly $1 trillion of this $3 trillion of debt, that's BBB, as investment grade when it has leverage ratios debt to EBITDA ratios that are worthy of junk bonds. So the average BB junk bond has a debt to EBITDA ratio of 3.2. We have a trillion of the 3 trillion BBBs that have a debt to EBITDA ratio in excess of 3.2, in fact, in excess of 4.
So when does the cycle turn, Bruce? Are you waiting for that to get in? Are you watching this with, licking your chops?
Well, we think that the cycle, and by the way, when the cycle does turn, we believe that the BBBs that become junk, a minimum of 9% of that universe to a maximum of 17% of the universe, because we've studied every prior recession to see how many fallen angels that is high grade falls to junk, and the minimum number is 9, the maximum number is 17, and so if the high yield, if the BBB market is 3.1 trillion, 9% of that is roughly 275 billion. If you working with a 17% number, that gives you around 525 billion that falls to junk, with no liquidity really in the high yield market to speak of. If you add up all the balance sheets of all the investment banks, they carry about a $2 to $3 billion balance sheet of high yield bonds. And so when these tens of billions or potentially hundreds of billions falls into junk land, it's watch out below, because there's going to be enormous price adjustments.
So what are you doing to prepare for this, and when are you anticipating it will happen? I mean, Janet Yellen has been pretty vocal recently about, areas.
So I think for now the economy is strong. Earnings are strong. 50-year lows in unemployment rate, GDP's going well, and I think that all continues into next year or so. But here's a statistic for your viewers. We went back and studied all the recessions going back to World War II, and 75% of the time, the recession begins 1 year after the Fed stops tightening their interest rates, when they tighten interest rates by 250 basis points or more. So we've gone from 0 to 2. We're on our way to 3%, we believe. So it'll be more than 250 basis points, and we believe the last tightening will be next September, bringing recession 1 year hence. So I'm more third quarter 2020 if I had to pinpoint a time, but it's certainly not next year.
And you believe
probably the following year.
It's the rating agencies that are going to start this, and then it's going to be a cascade, and we're going to see a lot of falling.
I believe it's weaker GDP, I'd higher interest rates, and the exhaustion of economic policy, because we're late cycle. Number one, that starts it. So I think it's the real economy that starts it. Number two, I believe there's an enormous amount of over-leveraged companies, as you pointed out, a record number of over-leveraged companies that exist today in the marketplace that are rated way too high of a rating, that when they fall, because they're done with cost savings, they're done with synergies, and they're not deleveraging. And so when they fall, when it becomes more apparent when earnings turn over, then they're going to get crushed.
Okay, so right now, I mean, distressed investing is the ultimate value investing in some ways, right? Right now, is there any value evident today? Are there opportunities out there?
Very little in distress today. There's a lot of dry powder looking to invest in distressed. The companies that you see that are distressed are really companies that are in structural decline, as opposed to companies that have cyclical issues. So it's companies that are deteriorating, and they're going to continue to deteriorate. A newspaper company that's losing advertisers and subscribers to the new media world that we live in today, you can restructure it today, it's going to get restructured again tomorrow or sometime in the future. And so it's really companies that are in structural decline, and that's not exactly what the value investors in distressed land like Marathon like to buy. We like to buy companies that are good companies with over-leveraged balance sheets, not bad companies.
So what about retail and energy? Are they done, those sectors, for you?
Well, I think retail's fine from here. I mean, there's some good buys in there and some companies that are troubled. Sears is a troubled company. We like Neiman's, for instance, as a company that we're long, and from the debt side, of course. And so they're going to be winners and losers from where we go here. In terms of energy, I think energy is fine at this level. I think energy probably trends higher. I think a lot of debt shouldn't be on energy companies, because it really should be an equity investment as opposed to a highly indebted company. Because when oil prices do go low and there's a very cyclical commodity, then companies can't support that level of debt.
We're almost out of time, but I have to ask you, you have a short basket of about 6 to 8 BBB companies. Tesla is one of those. Does today's news make any difference to you?
Well, Tesla's outside triple, but Tesla is in the news today. New chairwoman who's taken over. She has some manufacturing knowledge and expertise, so she'll probably do a fine job in that role. The question around Tesla is they burn cash. They burn about $3 billion a year. They only have $3 billion of cash sitting in their coffers, and they have $12 billion of debt. It's great it's great company. It's great leadership, we think. Elon really should be chief engineer because he's such a brilliant person. But we think it's great leadership and a great company and great product. But the first mover advantage, guess what? Every other car manufacturer is going to have electric vehicles as well. Unless they hit their production numbers at a much faster clip than they're doing now, at this kind of cash burn, the debt can really start to become problematic for them.
Two more quick questions. We could talk to you all day, but is a hard Brexit still your base case, and have you added to positions based on that base case?
Hard Brexit is our base case. We believe that the politicians, including Theresa May, will stand up on stage and talk to everyone how this is a consensual deal, but it's going to be a hard Brexit because EU will not make it easy on UK leaving, and so it's going to be a hard Brexit. Having said that, UK's fine for now, and there's some value here and there in the UK, but I'd hold back my investments for now because come a year after Brexit, we believe there's a recession waiting. So and it may not be a recession, it may just be zero growth rate, but it slips from 1.4% growth to something like flat.
And finally, you're very active in emerging markets clearly as well, and frontier markets, but curious as to China, because now that's become sort of 15% of the emerging market distressed universe.
Well, China is a huge economy, obviously, and where we have trade negotiations, that is the administration with Mexico and Canada, with Europe, with South Korea and Japan, it's going to be an all-out trade war with China. And so we haven't even begun to write the chapter on how our countries are divided and how we see economic policy very, very differently. I think the administration is calling out China on IP rights and infringement upon that and all the damage they're doing to U.S. companies, as well as stealing technology and not opening their markets. Meanwhile, our markets are open to them. So I think that Xi doesn't back down on this. And I think Trump certainly doesn't back down on this. And so unless they come up with a compromise, which is not the base case, it becomes a trade war.
So you're not getting involved in any of that?
We would not buy China MPLs. We don't think as a foreigner you have rights to enforce in China unless if you're local.